This video is an uncovered Japan company research report on CHIeru, ticker 3933. CHIeru builds the software, language learning systems, and network tools used inside Japanese schools. Its shares look inexpensive and offer a high dividend yield, but the business is coming off a government-funded hardware refresh peak. The central question is whether its installed base can produce more recurring software revenue after that cycle fades. At the report's July 2026 reference date, CHIeru traded at about 8.9 times forward earnings, 1.06 times book value, and offered a 4.82% dividend yield. FY26 return on equity reached 20.4%. These figures need context. Management expects revenue to fall by roughly 22% in FY27, as the one-off GigaSchool device refresh wave rolls off. The valuation is therefore measuring both a real earnings trough and the possibility of a better quality recovery. CHIeru is unusual because it is a listed pure play on Japanese Education-ICT. Interclass lets teachers distribute and manage lessons across classroom tablets. Calibo and Cal provide computer-assisted language learning for high schools and universities. T-Bridge visualizes school Wi-Fi performance, while Extra Console helps administer large numbers of student accounts. This combination matters because classroom workflow, language learning, and IT administration are embedded in day-to-day school operations rather than being a single standalone app. The top line expanded from roughly 3.9 billion yen in FY23 to 10.2 billion yen in FY26, with operating profit reaching 1.07 billion yen. That is a striking increase, but it should not be read as pure organic software growth. The National Giga School program created a device refresh wave, and CHIeru also expanded through acquisitions. The next reporting period matters because it separates sustainable demand for the company's education software and services from a temporary surge in hardware-related activity. The segment mix explains much of the investment case. K9 schools produced 32% of sales and a 14.9% operating margin in FY26. High school and university work contributed 30% of sales at a 12.5% margin. The largest segment by revenue, enterprise and public sector, accounted for 39% of sales but earned only 5.2%. It is largely acquired installation, network, and maintenance work. Future group profitability depends on protecting the software-led segments and improving this lower-margin acquired base. Cash flow was the encouraging FY26 data point. Operating cash flow reached 2.33 billion yen, and free cash flow reached 1.86 billion yen, aided by a rise in contract liabilities of about 850 million yen. That increase can signal more revenue collected ahead of delivery or service. But the projected FY27 through FY29 cash flow figures on this chart are the report author's estimates, rather than company guidance. Investors should watch whether contract liabilities, managed service adoption, and cash conversion stay resilient after the Giga refresh peak. CHIeru's moat is practical rather than flashy. The report estimates that roughly 40% of Chromebook adopting local authorities use a CHIeru product. Once a teacher's classroom workflow and a district's IT processes are built around a system, changing it mid-cycle is disruptive. The Language Lab franchise also reflects specialized pedagogy and engineering. Still, the moat is not absolute. Public education budgets are cyclical, and better capitalized platforms can compete for the same classroom software layer. CHIeru's growth also reflects a long series of acquisitions. The strategy added geographic coverage and adjacent education services capability, but it changed the balance sheet and the earnings mix. The equity ratio fell from 44.1% in FY24 to 27.6% in FY26, while return on equity remained double-digit and reached 20.4% in FY26. The company also carries goodwill from these deals. The key issue is not simply whether acquisitions increase sales, but whether they create cross-selling and margin improvement, rather than persistent dilution. The forward strategy has 4 linked elements. First, CHIeru wants to convert one-off product sales into maintenance, cloud, and service desk revenue. Second, it is targeting school administration digital transformation alongside classroom technology. Third, it is embedding generative AI features into existing products, especially language practice and cloud-delivered classroom tools. Finally, it needs to improve the low-margin acquired public sector business. These are coherent initiatives, but they remain execution tests rather than results already reflected in the accounts. The reported FY26 peak is expected to give way to an FY27 air pocket, with revenue guided toward roughly 8.1 billion yen. The later FY28 and FY29 recovery shown here is an author estimate, not management guidance. The investment debate is therefore qualitative as well as numerical. A lower post-peak revenue base could still be healthier if it contains more recurring software and service revenue, and if the acquired public sector segment stops diluting margins. The next several quarterly results will test that proposition. The valuation work is best viewed as a range, not a forecast. Using the report's assumptions, the FY29 outcomes span roughly 342 yen in a bear case, 755 yen in a base case, and 1,183 yen in a bull case, compared with a 477 yen reference price. These are author estimates, not price targets. The variables are specific: whether the K9 segment recovers after the gigatrough, whether more revenue becomes recurring, and whether public sector margins improve. Policy budgets, demographics, competition, and microcap liquidity remain material risks. CHIeru is a focused education ICT company with embedded classroom workflows, language learning technology, and evaluation that reflects a difficult post-refresh year. Its opportunity is to turn a policy-driven hardware peak into a more recurring software and services base. Its risks are equally clear: education budgets, a smaller school population, AI competition, and a low-margin acquired business. The most useful indicators to watch are contract liabilities, service adoption, public sector profitability, and the FY27 quarterly path. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.